Are you passionate about shaping India's future? Keen to find solutions for India's most pressing challenges? Look no further than Takstashila's postgraduate program in public policy. This 48-weekend program will equip you with the knowledge, skills, and network needed to pivot to a meaningful career in public policy. Apply in the link below by June 1st. The program begins June 20th. Hope to see you there.
Welcome to All Things Policy, a daily podcast by the Takshashila Institution. We are a bunch of policy nerds based in Bengaluru, and we like bringing fresh perspectives to Indian affairs and Indian perspectives to global affairs. So grab a cup of coffee, sit back, and join us for today's chat.
Hello and welcome to this episode of All Things Policy. In today's episode, we will try to understand the impact of the West Asia war on India's economy. While India's imports of oil and gas largely contribute to the economic impact, there are additional factors that could aggravate this impact on the Indian economy, right? So I am Bhumika Sevkani, research analyst with the Geostrategy program at the Takshashila Institution. And to help us see the whole picture of this impact, I am joined by my colleague Anisree Suresh, a research analyst with the Geoeconomic program. Welcome, Anisree.
Thank you, Bhumika.
So, Anisree, let's just dive right into it. The first and I think the most important contributor of this in this economic impact, as I mentioned earlier, would be our import dependence in the energy sector, right? We know that we import about close to 90% of our crude oil requirements, about 60% of our LPG requirements, which I think this figure has changed quite a bit after we ramped up our domestic production, but we still significantly rely on the LPG imports, and Strait of Hormuz was one of the most critical supply routes for us in terms of LPG and LNG. So tell us about how this India's energy dependency acts as a major channel in the economic turbulence that we feel in India due to the West Asia war.
Yeah, thanks, Bhumika. It's a very important question because, I think since the war started, we have been discussing the LPG crisis, the LNG, the auto prices, and everything else that have been going around. And all of us in India had felt or are feeling like the pain of the war that's happening far from us. So global geopolitics is always that way, right? It has played a crucial role in shaping dynamics, economic dynamics especially. And certain conflict in certain strategic regions can always influence international trade, how the energy markets behave, the financial stability of the world, and of course the economic growth, right? So the ongoing conflict in Iran is one such geopolitical crisis, I think, that has disrupted the global markets and created economic uncertainty worldwide. So if you look at India maintains very deep economic connections with West Asia through energy imports, trade relations, and we also have remittance coming from that part of the world. And there's a lot of logistics network, like you mentioned, the Strait of Hormuz and everything, right? And India is very particularly vulnerable to the ripple effects of this conflict because of the multiple channels of that through which the conflict affects India. And one of it, like you have rightly mentioned, is the rising oil prices. And of course, there are other aspects like disruptions in the maritime trade routes, the inflationary pressures, and the stock market volatility, all those things. But the primary channel here is India's energy dependency. So India is again one of the world's third largest oil importer in the world, and it's particularly vulnerable to such geopolitical tension because of that dependence alone, right? So I think we import around like 80 to 85% of its crude oil requirements from international market, and much of it is from the West Asia alone, right? Consequently, any disruption in oil production or shipping routes in this region directly affects India's economic stability. So everyday Indians consume around like 55 lakh barrels of crude oil or something. And we have a refining capacity of some 258 billion tons per annum or something. And again, LPG consumption, we have discussed it in detail before also. Like we used to import around 60% of its total consumption. Now we have reduced to some 40 to 50%. But however, like a lot of it passed through the Strait of Hormuz. So this alone has multiple impact. So since India imports majority of its oil, any increase in global prices directly raises India's import bill, and that widens the trade deficit. And then you have higher oil prices also increases the cost of production, transportation, manufacturing, electricity production, which in turn leads to inflation across the economy, right? So when oil prices rise, India need also more foreign currency, dollar, to pay for its imports as well. So this increases the demand for the US dollar and again weakens the rupee, making imports more expensive. So just the fuel prices alone has multiple impact on the Indian economy if you really look at it.
Right, absolutely, Anishi. In fact, that was one of the additional factors that I was planning to discuss on the inflation rate, as you mentioned. So,
Yeah.
given that the oil prices have been consistently above $90, $95, and if the conflict continues, it could even go above $100 for a longer period of time. And
Yes.
this directly obviously affects the inflation rates in our economy. So, and that is what the inflation rate is what I think matters most for an average Indian consumer too.
Yeah.
So, could you take us through the different scenarios of, let's say, a prolonged conflict, and how could that scenario impact the inflation rates in India, and what would be its wider impact on the Indian economy?
Yeah. So, like you rightly mentioned, again, rise in fuel prices definitely have a direct as well as indirect impact on the Indian economy. So, it affects multiple, right? So, the direct impact is like, the direct prices increases for the petrol, diesel, LPG, and the aviation fuel, kerosene, and all those things. And then the indirect aspect, like I mentioned earlier, like the rupee. So every dollar of oil is paid in dollars. So a weaker rupee multiplies the bill. And the third impact is again the food aspect. So again, a lot of fertilizer is made from natural gas, and you need diesel to run the tractors and the irrigation pumps and the trucks to move the produce. So there's a direct impact on the food inflation. And then you also have the industrial element where you need LNG for steel, ceramics, fertilizers are again used, LPG for stainless steel and chemicals. So all this like industries that get affected, these all have an impact on the inflation element, right? So if you look at the consumer price index or the CPI, in the March alone, it rose to 3.4% from 3.2% in February. And that's basically driven by the food and the electricity, gas, fuel category alone, right? So the transmission rule of thumb is like every 10% rise in crude oil is estimated to push the consumer price index up by 40 to 60 basis points if it's fully passed through. Okay. But again, we might not have seen the worst of the inflation spike yet because of some temporary measures that has been taken. For example, the LPG cylinder prices haven't been fully passed to households yet because of the subsidy and a lot of other aspects. And also the government got the special additional excise duty on petrol and diesel to absorb part of the shock as well. So kind of in a way that they swapped the fiscal pain for price pain in that sense. So in the sense they didn't allow the consumers to feel the pain of this increase in the fuel prices or anything. They tried to take it as a fiscal pain that the government was trying to take in that sense. So despite all of that, inflation has already moved up some 70 basis points in the last 2 months alone, right? And a lot of projections are there that we're looking at CPI for April is to probably going to cross 4%, and 4% is the maximum comfort level in terms of inflation. So we're probably going to cross 4%, and even RBI's own projection is that 4.4% for April. And then the second aspect, if you look at it, the rupee multiplier thing. So India pays for oil in dollars. So again, rupee fell from around 83 in last year to last year, I think around that period to now it's around 95 in March. And now we are settling around that 93 to 95 and all those things. So that's again roughly a 10 to 12% depreciation, right? So even if dollar oil prices were flat, they are not gone up or anything, a 12% weaker rupee makes oil 12% more expensive in rupees alone, right? So that means like even if the dollar prices were flat, the oil prices is already expensive for India. But now the dollar prices are not flat; it's also going up as we speak of. So that means like we are feeling a double whammy in terms of like the rupee effect and all those things. So the imported inflation in India was already running at 5.7%. About a quarter of the CPI basket is imported. So this really matters. And then other aspect is like in the food chain. I mean, this is where the inflation story kind of turns from inconvenience to a household budget crisis kind of thing. Where, if you look at it, the rural India, where food is like almost 47% of their consumption basket alone, right? So the fertilizer bill that has gone up, so that has a lot of like impact on the food aspect. And we need a lot of, especially the sowing season is gonna start in the next couple of months and stuff. So like the fertilizer is very much important to ensure that our food bill is not going up and all those things. And like I mentioned, you need to power tractors, you need diesel for irrigation pumps and all those things. And every rise in diesel kind of cascades into vegetable milk and grain prices as well. So this, it's all connected, right? So you can't kind of protect one sector of the economy from that. So even the food and beverage inflation is expected to cross beyond 4 in April alone. And we are like, if this continues through June or August, if the war continues through this period, that's the sowing season in India, that means the food inflation could probably touch 6%, even if we are getting a normal monsoon. And there are a lot of reports coming out, we might not get a normal monsoon this year. So it's all like quite a lot of problematic. And like I mentioned, industrial cost, again, I have already mentioned. So LNG goes to steel, fertilizer, glass, chemicals, ceramics, and all those things. So we already started doing industrial gas rationing, which had led to some production cuts of 10 to 15%, especially in steel industry and all those kind of thing, which is one of the prime industrial sectors that we have. So this means that steelmakers are already raising some of the domestic prices to protect their margins and stuff. And that means like higher steel prices feed into construction, autos, white goods, that would have a further impact on the inflation. Yeah.
Right now, thank you, Anisree. I think there was a very comprehensive analysis, and especially the numbers that help us in understanding how the inflation could unfold going ahead, right? And you also mentioned the sectors that might be affected, sectors like steel and other industries that also play a major role in our exports, right? So my question was that there are some projections already coming in on how the conflict could affect India's GDP growth. And so we had seen that the March 2026 RBI bulletin showcased that quarterly GDP growth remained high at 7.8% in the third quarter, despite the global uncertainties. But as and when these sectors start getting affected due to the high fuel prices, what would be the impact on India's growth story? Do you think it will impact us negatively going ahead? How do you think that will pan out?
That's a very interesting question, right, Bhumika? So the real damage is mostly towards the narrative that we were building, right? We want to say that, okay, we are the most emerging market, that is like, we are like conducive to businesses, investments, and all those kind of things. And that's a narrative that we have been building. And the loss, or probably the image, the damage is going to act on that image alone most probably than the numbers, right? So if you look at it, and the compounding loss of growth at the moment when the global capital was repositioning towards India, and that's the impact it mostly going to have. To look at some numbers, I think pre-war we had some consensus among various reports that India would grow around like in 7% or 7.5% in 2027. And building on like the projections for the 2026 was 7.4% and everything. But now with the war started and with 2 months into it, like the discussion that RBI itself is saying that our growth will be at 6.9%. But if you look at the projections from Moody's or Goldman Sachs, they're saying 5.9 to 6% growth for 2027. So if you look at it, more than the numbers, what I want to focus on, like the compounding mechanism that would impact on this growth narrative, right? So one, if you look at it, the capex cycle, the capital expenditure cycle, how that would be impacted. So if you look at it again, in the 2025-2026 period was the time that the private capital expenditure was improving, especially after the COVID and everything. And it was also the time that the government capital expenditure was also high, along with the household capital. So these three elements are the most important engines for our economy to sustain that 7.5 growth or something, right? And our budget for 2027 was also built on this assumption that the government capex is still elevated around like some 11.2 lakh crore for 2026, and private capex is accelerating with banks reporting sustained corporate loan growth and everything, and the household capex, which is again booming. Again, that's mostly on the real estate angle, right? So the real estate sales have been at multi-year highs in the last 1 year and stuff. So the whole 7% plus growth thesis for 2027 rested on this triple engine firing thing. And that's when the war happened. So now the India's private capex, that's basically all this decision for capex comes from explicitly, and they're very sensitive to three things, right? One, the input cost certainty and the financing, like whether RBI is going to cut the rate on the interest and everything, whether banks are going to expect hikes, and all those kind of things are dependent on it. And there is also a demand aspect where the consumer caution, what is the FPI outflow, the currency volatility, all these things are considered when you're making a capex decision. So when you have companies face this much uncertainty about an economy, projects get cancelled or they get delayed by like 6 to 12 months and stuff. And that affects the private capex in India, which is one of the major engines of growth. Right? And then if you look at the second mechanism, the fiscal squeeze on growth, supporting spending and all those things. So if you look at it, at the current scenario itself, the government has three immediate fiscal hits coming. One, they have already cut down their excise revenue. So that's gone from the petrol and diesel duty cuts. And second aspect is the fertilizer subsidy bill is again rising to some 1.5 lakh crore or something, or possibly higher. And the third, you have the LPG subsidy. So that means like despite the import cost surge and everything, we have been administrating the prices, they're much not increasing. So that means these all would have a higher impact on the fiscal drag, and that could be around 0.4 or 0.7% of the GDP. And at a time when the government's debt was supposed to be brought down to a really low percent, and that's what we have been aiming for. So either this deficit slips or the capex gets cut. It's that scenario. And considering that capex was the engine of the growth and everything, this will be a fiscal squeeze that India would be facing.
Right. Yes, Anisree. So about the fiscal pressures that you mentioned, I think that is also notable. So another aspect that I would like to steer this conversation towards is the remittances that we receive from the West Asian countries, right? We know that we have a significant diaspora in all of those countries, and they also contribute to remittances. So how do you think that is going to be impacted? Do we already see some remittance flows being affected due to the war, or is it still yet to be seen the impact?
Yeah. So again, one of the remittances is one of the most important factors for our Indian economy. So I think we have around $51 billion in remittance flow that we usually get annually from the Gulf countries alone. And we have around 9 million Indians work in the GCC countries, right? So, so all these things are there. And we have some of these diaspora coming back in the last 2 months because of sudden pause in the labor markets and everything, and also some are laid off and all those kind of things. So there is some displacement in the labor happening, of course, and this definitely have an impact, especially for states like Kerala, Tamil Nadu, Andhra Pradesh, because remittance is a major source of consumption demand in these states. So, for example, a sustained 10 to 15% drop in remittances could easily translate into lower domestic consumption, especially for Tier 2 and Tier 3 cities in these states, especially, right? And again, another aspect is not just the remittance alone, with the logistics and the Strait of Hormuz, that it's definitely having an impact on India's merchandise export, not just to the other parts, but also to West Asia, where I think 16% of India's merchandise exports go to West Asia. So, with Gulf economies under stress, with the effective blockade that we have in the Strait of Hormuz, demand for Indian exports, especially textiles and engineering goods and gems and jewelry, are dropping. So, I think in the one of the Goldman reports they have put it in that way that unlike the past oil shocks where Gulf economies boomed and bought more from India and send more remittance home. This time, the Gulf is hurting with India, and that's again a concern for India. And again, if you look at the jobs and demographic math, right? So we have been in that again the growth narrative or the growth story that we have been selling, that India needs to create roughly 8 to 10 million jobs a year to absorb its working age population, and usually we get a lot of high growth jobs at 7% plus growth, or ideally at 8% growth we will be able to generate that much of jobs for our working age population. But 6% growth doesn't generate enough. And with all the predictions that it will be at 6.5.9% and 6%, that means the probably that many jobs won't get generated. And if you look at it, a sustained 6% growth path for next 2-3 years means a real demographic dividend deficit. It means like millions of people might not find the jobs that they are trained for. So it's a slow burn cost in the sense like it might not be completely shown up in our 2027 data or GDP projections or anything. But over the years, it shows up in terms of the unemployment data, in the migration patterns, the political instability, and all those things. So there is a slow burn cost to economy as well from this conflict. Yeah.
Right. No, in fact, the things that you mentioned about the slow burn cost and how it could impact the Indian economy for years down the line. And it is not just the Indian economy. You also mentioned about the Gulf economy is hurting. So we know that their oil and gas refineries, the energy infrastructure that has been damaged will take quite a few years to be repaired. And the supply might again take that much time to resume to normal. So, how do you see, and could you just sum it up for us on how do you see the long term impact of this conflict on the Indian economy?
Yeah. So I just want to highlight one point here. India is definitely exposed to this conflict. It will definitely slow down a bit. And the longer this runs, the more the damage that it compounds. But the story that I want to say is this is not what that India is going to break or anything. The story is that India's exceptional growth premium that we were selling, that 7% growth and everything. That was also a thing that global investors were paying up for. I think that might get temporarily paused or erased. Right. So that's something that we have to be careful about as the conflict, extends to our time. So if you look at it in a scenario analysis, if the conflict goes on for 3 to 6 months, or the medium term would be like 6 to 12 months, and a long prolongation where you have the conflict going beyond 12 months. So the damage to India in all these three scenarios won't be linear across, right? In the sense that it's non-linear, in the sense that I think the second 6 months hurt much more than the first 6 months. And I think the third 6 months hurt disproportionately more than the second one because of the second order effects on the economy and everything. For example, in the first 3 months of a shock of this crisis happening, economy runs on its buffers, right? And for example, India has serious buffers. We have some 696 billions of forex reserves as of now, and we have around 11 months of import cover. We have a good, strong, confident fiscal space, and we have some strategic petroleum reserves, deep service exports, household savings. This system can absorb the blow for a short period of time. But if you look at it from the second 3 to 6 months period, buffer starts running down eventually, and you have some kind of pressure on the forex reserves as we spend defending the rupee and everything. And the fiscal space also gets eaten by subsidies and all this like additional expenditures in the last 6 months. And the corporate inventories also might deplete, household dip into savings, and all these issues could happen in the second 3 to 6 months. So beyond the 6 months, the buffers are largely exhausted, right? And you start hitting the structural damage aspect where you have the capex deferred for a really long time. That is enough to become a capex cancelled, right? If it's not happening for the next 6 to 12 months, it's as simple as it's getting cancelled. So beyond 12 months, you start losing things and you can't easily get back. You have the capex projects losing, the manufacturing market share depleting, inflation targeting credibility issues, labor market trajectory going down, the fiscal space is affecting. And while I also have to say that none of this is as catastrophic as we had it in the 1991 sense, but and it's probably not going to lead to India getting an IMF bailout or anything like that. So we are not looking at that scenario. But the cumulative cost of a long war is that India's growth trajectory shift down by probably a half percentage point to a full percentage point, and probably possibly for the rest of the decade. That means, over the couple of years, there's that much generation of jobs not being created, factories not being built, the tax revenues not being collected. So that has a huge impact on the Indian economy in the long term, right? And that's what we want to avoid at all costs. So for India's economic interest, the conflict has to end as early as possible. Yeah, that's all.
Absolutely. I think all of us would agree on your final point that the conflict must end for in India's interests, and not just India's economic interests, but I think the global economic interests as well, right? So thank you, Anisree. I think thank you for taking us through all of the various factors that can compound their effect and build fiscal pressures for India going ahead. And I think one key takeaway from this episode would be how severely geopolitics can impact economies around the world. But yes, thank you, Anisree. Thank you for taking us through these details and for this comprehensive analysis and the different scenarios that you explained to us.
Thank you, Bhumika. It was a pleasure.
If you liked our show, dive into Takshashila's research on technology, strategy, and economic affairs. Check us out at our Twitter handle @TakshashilaINST or our website takshashila.org.in.